Individual investors shouldn't buy bonds. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Individual investors should stay out of bonds. If you have them in your portfolio, either bail out or make sure the maturities are no longer than 3 years. Now, some institutional investors, such as insurance companies, have to purchase bonds for regulatory purposes, but not individuals. Because the great bull market in bonds that began in the summer of 1982 is over. Treading water is the best that bondholders can hope for now. Until recent months, bonds have been a positive investment, but that is changing. Interest rates on treasuries have gone up from where they were in 2020. That's a sign of trouble to come. But because rates are still extremely low by historic standards, many investors have been reaching for yield by buying bonds of less than stellar companies. The yields they're getting on this paper, however, are way too low considering the risks they are taking. When the economy slows next year as the sugar high from all that government spending wears off, many of those shaky companies will falter, and the bonds they issued will default, as those corporations either restructure or are liquidated. Even the yields investors get on bonds issued by the federal government are miserable considering the likelihood that we'll be experiencing more inflation, thanks to the possibility of even greater spending by Uncle Sam. We have never seen anything like this prospect of spending and ever more increases in the national debt during peacetime. Eventually, even the mighty Fed will not be able to suppress interest rates. Reality will set in. Rising interest rates mean, by definition, lower bond prices and losses for investors who hold them. Of course, if the Biden administration doesn't succeed in its plans for massive tax increases, if Congress sharply scales back the White House's spending proposals, and if the Federal Reserve doesn't gin up its printing of money out of thin air, then we'll avoid the worst-case scenarios. But those are a lot of big ifs. That's why investors will do well by not buying bonds today. At best, the price of treasuries and the bonds of blue-chip companies will be flat, and the bonds of other companies, not to mention many mortgages, will be poor investments because the difference between their interest rates and those of high-quality issuers is still too narrow to justify the risk. To repeat, if you want to buy or hold bonds, stick to ones that mature within 3 years or less. You won't get much of a yield, but you'll be far less likely to suffer painful losses. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.